Today we're going to go over what's most important for investors when they're looking for HELOCs. Now HELOCs could be either on your primary residence or your rentals. Whatever you have, you should have a HELOC on it. For the last 23 plus years, we've been working with thousands of investors funding over $1 billion in loans. What we find is the investors who are set up correctly, which is with HELOCs, lines of credit, business credit cards, and real private money, are the ones who succeed because they have more money in their life. Today we're going to go over the 3 things you need, the most important things for investors and HELOCs. Remember now, HELOCs for investors, you're going to use it for down payments, earnest money, keep the project going, pay for those bills, and even sometimes just buying a property outright. It's easy access to funds whenever you need it. It might not fund everything, but it sure helps fund a lot. So number 1 by a landslide is loan to value. The amount that the credit union or the bank is going to give you on that property for your line of credit. What you're going to find, depending on the property type, is they're going to be somewhere between 70 and 90% in this market. In other markets, they've gone up to 100% LTV, loan to value. They might also throw in CLTV, which is combined loan to value, and we're going to go through that. But loan to value is the number 1 thing you should be looking at because that gives you more money to do more things in real estate investing. But now let's look at what that means because it's loan to value, but you already have a loan on that property. So if they're talking about loan to value of, let's say 70, 80, or 90%, and you're going to find most banks and credit unions right now are in that 80%, but there are banks out there who will do 90%. And some are limited to 70%. But what does that mean and how do you figure that out? So we're just going to go through a quick example here. So if someone's going to give you 70%, a bank going to give you 70%, and let's just say our property is worth $400,000. So what they're saying with a HELOC, they'll allow up to $280,000, 70% of $400,000, $280,000 in loans on that property. And the same with 80%. So if they're going to do 80%, they're going to allow you up to $320,000. And at 90%, $360,000. So that's the total loan to value that they're going to allow on a property. But most people already have a first lien or mortgage on their property. So what the credit unions are looking at is remember we said CLTV, combined loan to value? What they're going to look at is what do you have on the property now? So let's, for example, look at a property that is worth $400,000 and their first mortgage is $270,000. So they already owe $270,000 on the property. And the credit union, in this case, let's just make this a little darker. They're going to, remember, allow $280,000, but you owe $270,000. So all they can lend you is $10,000 for a HELOC. And this is why when we talk about loan to value is the most important because we're going to try to maximize the amount of money we could get on this HELOC, even if the rates go up, and we'll go through that in a little bit too. It's the same thing. This property, if you find a credit union bank that'll go up to $320,000, now you have $50,000 available for repairs, down payment, whatever it is. Now you have $40,000 more. If you find the credit union, of course, or bank that'll go up to $360,000, still $270,000, but now we have $90,000 available for a HELOC. So that's why number 1 on our list, which is most important, is making sure you're working with an institution that's going to give you the maximum loan to value, gives you more flexibility, more things you can do with the money from this HELOC or line of credit. Number 2 is draw period. Now in a HELOC, what they do is they have 2 different sections of it. They have the period that's the draw period. That's where you could use it like a line of credit. You could take money out. You could use the money for repairs, down payment, anything that you could think of during that draw period. And then when the property, sells, you could pay it back off and use the money again and pay it off and use it again. That's the draw period. Most HELOCs come in 2 different draw periods, either a 5-year or a 10-year. The longer the draw period, the more flexibility you have. Yes, on HELOCs, you can refinance them at any time, and I always suggest you're out there looking maybe yearly at least every 3 years, looking to see if you can improve your HELOC and maybe expand your draw period. But you should always be looking for the longer draw period. Gives you more flexibility. What happens with your property in a down market where the values start coming down and you go to refinance? You're going to get less on your HELOC. So at the very least, when you start out this process, set it up to be long-term, even if in the future you may refinance it. Look for the highest loan to value and the longest draw period. As we mentioned, number one is loan to value by a landslide. You want to maximize what you can get out. Number two is draw period. You want 10-year, 5 years fine because you got to always refinance. Third, in this kind of market, is interest rate. What are they going to charge you? Typically, HELOCs are based on prime plus a number. And that number, that plus number, is where the banks make the profit. Almost all banks use prime as their starting point, but then they add a factor. They add either 1 or 2 or 3 to prime to determine your rate. If you could get a fixed rate for more than a year, we've been locking people into 5-year fixed rates. 3 or 4 years ago, we did a 10-year fixed rate. As rates rise, you want to really lock in and know what you're getting instead of just using the teaser or the adjustable. A lot of banks out there will give you the prime -5 just to get you in. It's kind of like a credit card giving you 0% up front and then the interest rate, jacking up once you get used to it. They understand once you get a HELOC, you're less likely to refinance out. Our theory is always be looking at refinancing. But number 3, in this current market, look for a fixed rate and see if you can find one. We have them here in Colorado. A couple credit unions will give us a 5-year fixed rate, so it's not going to adjust. We know as we're drawing money out, even in year 3 and 4, if rates go up another 1 or 2 points, we know where we're at. We're going to maximize our loan to value, we're going to maximize a draw, and we're going to try to get a fixed rate just so we know where we're at as rates and things change. In a declining market, we may look at something different for number 3, but we are where we're at, and for the next couple of years, fixed rates is the way to go. Remember, as an investor, you want as many options as you can that you control. That's the HELOCs, that's the business credit cards, especially the 0%, and that's some real private money. Now, when you're looking for HELOCs, make sure you go by these guidelines. Max this out, get this as long as you can, and get that fixed rate. Now, if you're looking for some information like how do I talk to these banks, we have a free download. Check below. We do studies. We actually call all the banks, all the credit unions here in Colorado and a couple other states, seeing who has the best rates, who has the highest loan to value. So we have questions we ask more than just this: credit score, kinds of houses, single family, duplexes, owner occupied, non-owner occupied. If you want that, check out the link below, and we'll see you on the next video.